Okay, we're now going to look at volume. Okay, to me, beside the price action, volume is the most important component of the, an equity analysis. Okay, the Japanese say truth is not determined by the volume of your voice. Okay. But truth is determined by the volume of the volume. Okay, how high the volume is. Okay, the volume obviously measures the intensity behind the move. The theory is that you want the volume in the direction of the move. Just a little bit of a subtlety is that volume is more important going up than going down, because to keep a rally going, you need the bulls behind you. The market could fall of its own weight. If there's a lack of demand, the market could fall. So it's better if even during a downtrend you have higher volume, but it's not a prerequisite like it is during an uptrend. So here, the market broke above a resistance area, and normally if we like to see a tall white candle break above resistance, but in addition to that, we want to see volume confirming it. So here, the market broke above resistance, light volume, and what we mean by light or heavy volume, it's relative. Okay, X number of shares, let's say 50 million shares in one stock might be tremendously heavy, and another one may just be moderate volume. So it's related to what happened previously. So you can see the volume here on that vertical, on the line there, is light volume breakout. And what happened to get us more nervous? All of the candles a few days after. The series of doji, exactly, right. That's right. And away she went. Once again, you can't predict the extent of the move. So this is a classic way of using volume. You want to see volume confirming the breakout on the upside. And then, okay, this is just absolutely classic. The green volume means it's an up day. The red volume means it's a down day. So here we have a tall white candle on the left with high volume, nice and bullish. The market's kind of rolling over. The spinning tops are giving us a visual clue that the drive is losing force. And then look at the black real body. So what's happening is the bulls are in control. The small real bodies are showing us the momentum is easing, and then the bears took over. So this is a variation. Anybody recognize this pattern we talked about yesterday? A variation of evening star, right? Tall white. Normally it's a small real body, but and once again the beauty of adding candles and Western tools. Doesn't this make sense? Right? Just I would always, for those who trade equities, always look at volume. I have volume on the bottom of my charts. Same thing here in the middle portion. An evening star, also a bearish engulfing pattern. And look how, let's view this from a bearish engulfing pattern perspective. Look at the volume on the black real body. Most of the time, the volume is not going to be this easy to see the difference. Most of the time with the engulfing patterns, bullish or bearish, the volume is going to be about the same with the white and black. But at times, you're going to see something like this, which just adds extra probability of the market turning. It should mean it's going to be a more important resistance area. Okay, here on the bullish engulfing pattern in the green triangle, again, this is the candlestick recognition software. It shows this bullish engulfing pattern. And the higher volume on the white candle magnifies, doesn't make it 100%, but magnifies the likelihood of a reversal. With the bullish engulfing pattern, the bulls are dominating based on the candle lines. You like to see extra confirmation by volume. Same thing here, bearish engulfing pattern. Okay, the high volume is confirming that the momentum, the bullish momentum of the market has dried up. In fact, the bears are really in full control now. You know, as of that session, if the market gets above it, things change. If the market breaks above that resistance area, things change. Now, here we're going to be looking at a couple of things. We have a doji here. Now, normally, if a doji does not confirm a resistance area, I would recommend using that to lighten up on longs. For those a little bit more aggressive, if there is a high volume doji during a rally, that in itself, even if it's not confirming resistance, it's better if it does, but even if it doesn't, that's a warning sign, because the high volume means that there's a lot of buyers. If there's a lot of buyers, how come it's not a tall white candle? There has to be a lot of sellers. So as hard as the bulls are trying to propel the market, the bears have enough wherewithal to at least compensate all the bullish drive. And actually, this is called distribution. Smart money is getting out. Right? So high volume doji, especially during a rally, especially during an extended rally where the market's overbought, and we're going to be looking at overbought, oversold later, is a warning sign that the market is really stalemated. Now we have a black candle over here, higher volume, just confirming that the market is having some problems over there. But the main, then a bearish engulfing pattern over here in the middle, again, the higher volume on the black candle than the white candle. But the main thrust of this particular chart was talking about the doji and high volume. And the same thing on the downside. Normally, once again, just purely subjective, you may find it different in your markets. Doji work better calling rallies than downtrends, but if you have a high volume doji, especially after a steep downtrend, that means a lot of bears are trying to sell, and the only thing to keep it from a long black real body is a lot of buyers. Okay, that's what we refer to could be accumulation. The smart money is getting in. So I would certainly pay attention to a very high volume doji, either on the upside or on the downside. We know how much I like windows, so you can imagine how much I like high volume windows, right? So here we have a gap up with relatively high volume. Could be news related. Usually is with a volume spike, and the volume becomes the rising window becomes a potential support area. And here's a case in point. The market gap down with the doji. Now, normally a falling window is resistance, and we still would view it as resistance. But a relatively high volume doji means that the supply is being absorbed by the demand. And although there's a falling window over here, I would still be very nervous about being fully short here. I would still be net short, right, because of the falling window. And this is the final confirmation. But this high volume doji is a real good example of all the supply being absorbed by the demand. Okay, now, a enhancement with the crack and snap is if it's more than 1 day, I would strongly suggest adding volume to it. So, we want to see, and this is the same chart we had before, but just added volume. We'd want to see the market break the support on light volume, which is actually down here. And then when it gets back above the broken support area, whatever day it is, okay, like I said, it should happen over no more than 3 or 4 days, whatever day it is. When it breaks back above the support area, it should have high volume. And that makes sense, right? Light volume on the break, that means bears really don't have control, and the bulls are in control, so that gives you some extra confirmation. Now, many of you, I'm sure, heard the expression selling or buying climax. A selling climax is when the market, it's like the last sellers get out. There's no sellers left. The market's been moving down sharply, very high volume, and a lot of times the market after that will turn around because there's nobody left to sell. Those are longs who are waiting and waiting and waiting, hoping for the market bounces, finally give up and get out of the position. So here on the blue arrows, very high volume sell-offs. And what I use the candles for, and you don't see many selling climaxes, and this is true also for buying climax in reverse, is couldn't that first blue candle be a selling climax? Very high volume, right? The only time you know when it's a selling climax is when you get confirmation. So here, and to me the confirmation is obviously candles. So on the second black candle, very high volume, and what happened on the day after the second black candle? What kind of? It's a dual candlestick signal?
Harami.
Right, a bull harami, exactly. So that, to me, helped confirm that, indeed, that second session was a selling climax, and the market might rally after that. So just don't let high volume and a big black candle day let you think that's the end of it. It can keep on going down and down and down. You've got to get some sort of confirmation to let you know that the bull's drive the bear's drive is losing steam. Okay, for those who trade, how many trade futures here? Okay. For those who trade futures, I just want to briefly discuss, because there's no volume, or volume is delayed in the futures market, open interest. And again, I'm not an expert in open interest, but for those who trade futures, open interest is a way of gauging the strength of the move. Essentially, open interest represents the number of longs or shorts in the market. So one contract has a buyer and a seller. So one contract in open interest is one contract of a buyer and a seller. Anyway, here we have the market rallying, but the open interest declines. Essentially, for those who are familiar with futures, know that means it's short covering. And so that means that the likelihood of the rally is continuing is not that great. And this is what happened after. And I just want to spend a minute or two on this, because the idea is, this is good for all markets. So since volume is great in the equity markets, I wanted to talk about open interest in futures. Fortunately, nothing comparable in Forex. So here we have declining. We'll look at Bollinger Bands in a little bit. Okay, these are Bollinger Bands, the red lines, top end of the Bollinger, bottom end of the Bollinger, middle of the Bollinger Band. So we're going to look at Bollinger Bands here. We have a bullish engulfing pattern at the bottom of the Bollinger Band. But what I want to focus on here is this purple line. And what's happening is that we have declining open interest, which means that longs are liquidating. It's not new shorts, which is potentially bullish. So we're going to now look at overbought, oversold indicators. And overbought means the market's moved up too far, too fast. Oversold, obviously, is the opposite. And there are various ways of looking at overbought, oversold. First, we're going to look at the Western technicals, Bollinger Bands, oscillators. We're going to have, as far as the East is concerned, we're going to have record sessions, and we're going to be looking at the disparity index. But let me show you the importance of, and those are Eastern strategies, by the way, Western record sessions and disparity index. So let me show you what I mean by overbought, oversold. Here we have a market that's oversold, but it's relieving the oversold condition. Market moves down, trades up, sideways, it trades down, then it trades laterally, and this can go on for a long, long time. So, okay, stairway to heaven, right? Okay, stepwise progression, and the flip side is we have a stairway to hell. Okay? Can you see the little fire there? It's a little blurry there, so that's how a little guy ascending the steps of knowledge. I figured I'd turn him upside down going to hell instead of heaven up here. So we're going to be looking at various ways of gauging overbought, oversold. So first, let me show you. This is from one of the books in one of the translated books I had. And it's a little hard to see, but in the blue area here, there's the market's moving up. The market is moving up. There's a doji, okay, and the author here is showing that the market's going to turn down. Now, the next doji, which is diagonally across, the market is also moving up, right? And then he shows that it's continuing to rise. So what he's trying to explain is that the market is overbought here. It's not as overextended here. So the odds are higher for a turn up here than here. And we're going to look at ways to gauge overbought, oversold. So same thing with a doji and a downtrend. So here we have a market that's obviously very oversold, just looking at the precipitous nature of the sell-off. And the author is hinting the market might rally from there, whereas opposed to here, where the market also had a sell-off, a shorter-term sell-off, but the market wasn't oversold. So we're going to look at ways of gauging overbought, oversold. And one of the ones I really like using, a lot of traders also like using, are Bollinger Bands. Now, very important, we're going to be talking about indicators, Bollinger Bands, oscillators, RSI, stochastics, MACD. My joke is for the MACD, it's the Scottish oscillator, the Mach-D. Okay? And I probably got this from somewhere, so watching video, sorry, I copied that from you. I don't remember where I heard it from. So, but this is not really a course in Western technicals. I'll go over the basics, how I use them, maybe a brief overview of what RSI is and stochastics and Bollinger Bands, but this is obviously not in depth. The idea is I'll show you some of the indicators I use. Some of the indicators are the more popular ones. Like I'm not an expert on RSI or stochastics, but I know a lot of traders use them, so I want to talk about, combine them with candles here. But again, the ones you're experts on, stay with it. If you're an expert on RSI, you may know certain nuances. Use your insights and then add candles to it. So Bollinger Bands, essentially Bollinger Bands are a great way of gauging if the market's overbought or oversold. Classic, or the standard definition, it's 2 standard deviations away from a moving average. The default is a 20-day moving average. 2 standard deviations essentially means 95% of all the price action is defined by the top and the bottom of the Bollinger Band. And what's nice about that is the market becomes more volatile. What happens to the bands? It expands because it's 95% of the price action. As the market becomes less volatile, it contracts, right? And a lot of nuances you can do with Bollinger Bands if they're lower. If the market's less volatile and lower, you can actually do option strategies with volatility, waiting for the bands to expand. And again, I'm going to have some stuff on that on the specialized topic on candles and options. But beside that, you could use the top and the bottom of the Bollinger Bands as overbought, oversold. I don't want to call them resistance or support areas. That's too strong. So here, and what I would suggest, put Bollinger Bands, and the default is 20 days, 2 standard deviations. Most of the software do that. You can massage it sometimes. I like using an 18-day and 2 standard deviations. It doesn't make much of a difference. And throw them on the charts. I can tell you for a fact, based on the indexes I use, they work really well on the indexes. Okay? Semiconductors, the drugs, the S&P, they work really well. As far as individual markets are concerned, whether it's an individual forex market or an individual equity or futures market, throw them on the chart and see if you get something like this. Okay, what I did to make it less confusing, the normal Bollinger Band plot will have also a 20-day moving average in the middle. Okay? And there are actually things you could do in the middle of the Bollinger Band. Sometimes it gets to the middle of the Bollinger Band, but again, this is not a course in Bollinger Bands. So I'm just going to discuss using the top and the bottom of the Bollinger Band. So here we have a doji confirming the top end of the Bollinger Band. So this is a way, remember this section is on overbought, oversold. The market's overbought. We have a doji. It should become a resistance area, right? Top end of the Bollinger Band. Just FYI, a little bit of a nuance if you want a little extra confirmation with Bollinger Bands. What you could do is if it breaks above the top end of the Bollinger Band and then gets back under it, that's a bearish signal. And especially if you get candle confirmation. Remember, the final trigger is with candles. So here we happen to have what? And I'm not sure if it's quite middle, a dark cloud cover, right? And by the way, if there's something called an incomplete dark cloud cover, and that is when the black candle doesn't get more than the middle of the white wheel body, you wait for the next session for some confirmation. Okay, here it wouldn't have worked out, okay, because the market obviously rallied after that. But one of the strategies, if it gets above the Bollinger Band and gets back under it, so although we had a doji at the top end of the Bollinger Band here, you would see it got above there, then it came back down. You could add to your short position. Now, the market's at the bottom end of the Bollinger Band there, but any reversal signals? No. Okay, here in bonds, again, I tried to just show the usability of candles in all markets. Okay, it's a little hard to see. The dashed lines, top end of the Bollinger Band, doji, and so forth, and the bottom end of the Bollinger Band is a hammer, okay, over here. And here is an example also. You see how the market got under the bottom of the Bollinger Band, then got back kind of like, I guess, the crack and snap. Okay, just come up with the terms of Bollinger Bands with that, right? But here we also had the bottom end of the Bollinger Band. It got back under it, then it closed above it, and plus you had a hammer. Okay, here we have a Bollinger Bands. Again, bullish engulfing pattern and a bearish engulfing pattern there. Just to show examples, I don't have to spend much time on this. Okay, the bottom end of the Bollinger Band. Over here, a bullish engulfing pattern. Okay, here the market got back under the Bollinger Band. Not a candlestick signal we discussed today, but by the time you got the signal, I didn't think it would be a good trade because my first support area, we're going to look at risk-reward a little bit later, obviously. My first support would be down here. Okay, here we had a series of topping signals on the left, right at the top of the Bollinger Band here. And in this one, I did have the 20-day moving average. And the reason I wanted to show you this one, because sometimes the 20-day moving average also acts as support or resistance. And when we talk about moving averages, that's one of the ways you can use moving averages as support or resistance. But here at top end, market breaks above it, the top end of the Bollinger Band, but then we have a series of doji, right? And the market gets back under the Bollinger Band, which is a negative, and we have final confirmation with a bearish engulfing pattern. Market moves down. Actually, what do we have here? Small white in a long black real body. Bull hottomy, right? Okay. Down here, okay, not quite a morning star. This because the market didn't get above that, but here's a little bull hottomy. But the main thing I want to show is at the top of the Bollinger Band, like we had a bearish engulfing pattern here. Okay, another one over there. So it's a very simple way of seeing if the market's overbought, oversold. I'm going to show you different ways of doing it. You may have your favorite way, but this is one of the things that I do all the time is look at the candlestick signal in context. So here, these are all bear hottomy. You can't really be too negative on them because although the second real body is within the first real body, where are those second real bodies? Near the highs, right, of the first real body. So we would be more nervous if the market's really overextended. How do you tell if it's overbought, oversold? One way to do it is with Bollinger Band. That's actually how I do it most of the time. And so here, the first two here on this one and this one, based on the Bollinger Bands, the market is not overextended. Okay, the third one is. So once again, it's candles in context. And by the way, there was a bearish engulfing pattern up there. So there's actually two reasons for hesitation over here. Very clean-cut resistance area up here. And the top end of the Bollinger Band. Once again, don't think of Bollinger Band as resistance. Just think of it as an overextended area. Okay, east plus west equals higher confidence. Here is the bottom end of the Bollinger Band down here. Who's in charge of that long black real body? Bears. And look what's happening here. Actually a little bullish engulfing pattern. Okay, white wrapping around the black. The market's going from lower lows to the same lows. Okay, the market gets to the top of the Bollinger Band over here. We had looked at this slide yesterday, I think. Why is this not a bullish engulfing pattern, the white wrapping around the black? It's an uptrend, right. A bullish engulfing pattern has to come after a downtrend. I've seen traders lose big bucks on not realizing the importance of trend as related to candle patterns. And we're going to have a special section on that when we look at trade management. So here we have a resistance area, dark cloud cover, confirming resistance, top of the Bollinger Band, water of a great ocean, remember? Comes one drop at a time. It's these little clues. Evening star, doji, at a resistance area. This is a great sale. At a resistance area at the top of a Bollinger Band. Now we're going to be looking at oscillators. And an oscillator, for those not familiar with it, is a mathematically derived measurement of the market's momentum. Oscillators include RSI, stochastics, the MACD, and so forth. How many here use oscillators? Probably the vast majority, right? Okay. And again, this is not a course on how to derive the oscillators, but this will show you the ways so you can begin to think of using your knowledge in the oscillator you use and adding candles to it, and just to show some examples. So essentially, an oscillator is plotted on the bottom of a chart, so you have the price on the top of the oscillator, and these are just different oscillators, RSI, stochastics, and the MACD. And main uses, well, let me give a little background. What's an advantage of the oscillator is that it's very objective. It's a mathematically derived measurement. To me, the more important indicator is candles, because oscillators, as good as they are, what are they based on? Price. So the purest way to gauge the market's emotion is price, okay? Because oscillators are based on, it's kind of like a second derivative of price. So immediate price is most important. But it's objective. It's mathematically derived. Includes, as I mentioned, the MACD and so forth. Oscillators are best in lateral markets. I'm going to show you an example, because if you have a strongly trending market, an oscillator will get overbought, say an uptrend, and just be pegged in overbought territory. So it's best in lateral markets, and it's a way of measuring. The two main uses of oscillators, there's actually a few of them, momentum. We're going to be focusing on overbought, oversold, which is the focus of this section, and also divergence. And let me go over what divergence is. I'm sure many of you are familiar with it, but for those who are not. And for those who don't use oscillators, this might be a good first step to think about using them, because they're really very, very popular no matter what market you're looking at. Essentially, divergence is if the oscillator, whether it's RSI, stochastics, or the MACD, or whatever it is not confirming the price action. So bullish or positive divergence is when the market is making lower lows. So we can see on the left, upper left, the price at 2 is lower than 1. But look at the oscillator. And the oscillator, as shown here on the left side, does not make a new low. So it's bullish or positive divergence. And negative divergence is when the market's making a new high in price and doesn't confirm it with the oscillator. The Japanese say all clouds don't rain. And the reason I want to say that is because I've seen traders blown out of the market, especially during the 90s, because all the way up we had negative divergence. All the way up. So we need bearish confirmation. All clouds don't rain. How do we know it's raining outside? We feel the raindrops. The raindrops are the candle signals. Okay, that's the trigger. So this is like the yellow cautionary signal, or the yellow, whatever the reverse is for a bullish signal. But the real confirmation comes with candles. To me, this is takes a backseat definitely to candles. Remember, candles are normally the final trigger. So here, for example, this happens to be the RSI. And once again, you can do things like ADX to measure trend intensity, or you can just look at the chart, okay, and just see the markets moving up quite briskly, and you can see the strong uptrend, and look at the oscillator on the bottom. I'm not sure what it is, RSI. It just stays up there and gets into overbought. And we'll look at overbought, oversold levels, RSI, stochastics. They're usually oversold is usually 20% or 30%, overbought is 70 or 80%, but we'll look at that in a couple of minutes. Okay, so let's start with stochastics. And what stochastics are, again, mathematically derived. And essentially, the stochastics compares the price today to the entire range over X number of days. So the idea is that if the market's strong, closes should hover near the highs of the number of days you're looking at. So that's the major concept. The most common are 9 and 14. Nothing magic about those, but those are the most common. And there's two lines, %K and %D. And what it would mean if a high stochastic reading means that the market is hovering near the highs of its trading range over the last 9 days or over the last 4 days, or the closes are hovering near there. Now, the reason there are two lines is because the K line is a very fast line. It just really swings all over. For those familiar with stochastics, you know what I'm talking about. So the D, they take a moving average of the K, and then they will look at how they compare the K and the D. And I know I'm going through this quickly, what the stochastics are, but again, the idea is that you're familiar with how to use stochastics. If you're not, there's lots of educational resources. But the main ways of using it is if a faster K line, %K line, crosses the %D line from overextended levels, either overbought or oversold. Overbought could be, stochastics and most of the indicators are between 0 and 100. Okay? They're normalized between 0 and 100. So overbought could be 70 or 80%, depends who you speak to. Oversold means it could be 20 or 30%. And bullish and bearish divergence. Market bullish divergence, the market makes a new low for the move on price. The oscillator does not confirm it. Bearish divergence, the market makes a new high in price and the oscillator doesn't confirm it. So we'll look at some examples here. So here, and you can see which is the faster line because it's the one that moves is more volatile. So the faster line here is a %K, which is shown in blue. And it's above, so % blue here, % is here. So now, here we're getting a potential, and notice the slide title, Doji without and with confirmation. So we're getting a doji here. And assuming that you really like stochastics, you'd look to stochastics to see if you're getting some confirmation. Confirmation, the market is overextended here. It's above 70%. But is the faster K line above or below the slower D line? It's above. So for those that use stochastics, you want to see the K crossing under the D, which is not the case here. So there's a doji, which is a potential setup, but you're not getting confirmation with the stochastics, which, assuming that's one of your favorite indicators, stay with it. So you wouldn't do the trade here. Maybe lighten up on longs, but you certainly would not be aggressively short. Whereas a few sessions later, you get a doji, and you're going to see this a lot with the candles and oscillators. You're going to get the first potential sign of a reversal with the candles, then confirmation with the oscillator. Oscillators are lagging. Okay, you need X number of days or X number of units if you use intraday sessions to make the oscillator, so it's a lagging indicator. And this is very typical of what's going to happen. So here we had a doji. Oscillator was still, the K was still above the D. A day later is when you got the bearish confirmation with the K crossing under the D. Everybody see that? Make sense? Okay, especially for those who use oscillators. Same thing here. I won't spend much time on this. Bearish engulfing pattern. No confirmation with the K crossing under the D. Another bearish engulfing pattern, dark cloud cover in the red box. And the confirmation came on the day after the dark cloud cover. Once again, you'll see this a lot. You're going to get the early reversals. That's what the candles, and it's no surprise, right? The candles are going to be very often to give you the first to reverse. Okay, here we have a stochastic cross. So on the bullish side, a bullish engulfing pattern. You had a lot of stuff going on there. Bullish engulfing pattern, and I made this thicker so you could see it. The blue line is the K, and the dashed, a little hard to see, the dashed purple line is the D. So the faster line from oversold territory. See, it's down to 25%. Here. This is a great setup. What else beside the bullish engulfing pattern, stochastics, what else do you have going? Window of support, right. And look at how often the support area was tested. And I would be looking for the top end of the box range. It's a great trade setup, something like this. Here we have a bearish crossover on the right side with the stochastics. And once again, this is a candle signal we didn't talk about today, but barring that, okay, falling off the roof over here. We saw this before. I don't know if I'd do this trade because the problem is you'd have a potential support area over here. Okay. But from the crack and snap perspective, where's your target? The bullish engulfing pattern. Remember, with the falling off the roof. From the falling off the roof, where's your target? Your target is the most recent low, and here's where some subjectivity comes into it. Do you view the recent low as over here or over here? So I'd have this as my conservative target, see, and my more liberal target. But at a minimum, you should be out of longs. A lot of stuff going against you. You had the crack, the falling off the roof. You had a bearish crossover with the stochastics. Okay. So here we have a black candle within a couple of ticks of being a bearish engulfing pattern, and the bearish stochastic crossover. Just show just various examples here. And here we have a bullish engulfing pattern with the K crossing above the D. Okay, this to me is less important over here. Let me see if I have a, whoops. Okay, it's less important, although the K is above the D, is the stochastics oversold? No. Okay. You usually use the cross when the market is either oversold or overbought. When you're in 50% territory, it doesn't mean as much. Divergence, this is a good example. Here in the E-minis, the market's ascending. And all during the ascent, what's happening to the, this happens to be a stochastic oscillator. What's happening to stochastics? Is it moving higher? No, it's the same level, right. So if the market, see, the oscillators gauge the momentum of the market, and you want to see the momentum of the market in the same direction as the price action. So if the price is moving up and the oscillator is not, it's showing us that internally the market is weakening. And again, on this stock, we got so many signals. It was amazing. Okay, on the left side, the small real buys, the doji. On the right side, bearish engulfing pattern of falling off the roof. Here. And then we had a stochastic cross. Okay, a day after the bearish engulfing pattern. Okay, here we had a couple of things going on. We had support level. Now notice what happened. This made a slightly lower low. Even if it's the same low, it doesn't matter. A slightly lower low. And look what was happening to the stochastic oscillator. It wasn't making a lower low. Okay, so you had positive divergence, and then you had a bullish crossover. Here we had a piercing pattern, and a bullish crossover took place, I think, a day after. And I bet you almost all the time when you have something like this, you're going to see a candle signal first. If there is a candle signal. Remember, not every turn is caused by candles. Right? Not every turn is called by candles, I should say. But if there is a candle signal, it's very likely you're going to get it before the reverse of the indication with the stochastics. Okay, here in this particular equity, the market's making higher highs. And interestingly, this is one of those, remember we talked about with the trend lines, you make rising resistance lines. I normally wouldn't use that because we do have prior resistance that we get key off of. But look, it's interesting what's happening here. And I should have made this line a little higher over here. But as the market was moving up here, we got doji here and another doji over here. So although it was making higher highs, okay, the stochastics oscillator was making lower highs, bearish divergence. The doji were tending to confirm that for whatever reason, when the market got up there, it was just having a lot of problems. So here we have bearish divergence. Okay, this one, a little bit more detail. Here we saw something similar to this before, and this is something you could do if you have a candlestick signal and you want confirmation. Remember, east and west confirmation to increase the likelihood of the trade working. So here we had a bullish crossover in stochastics, but no bullish candle signals. See? In fact, we actually got a negative candle signal. Okay, so you had a bullish crossover, but no confirmation with the candle signal. What we want to do is have the Western technique. If it's a bullish technique, we want a bullish candle to confirm it. Here we have a bullish Western technical technique, but we don't have a bullish candle to confirm it, so you don't do the trade. Whereas here, we had a bullish crossover on this close. We're looking on the right. Any hints with the candles? So in other words, we have the bullish crossover in the red arrow here on this session. Any hint before about the market turning? Sure. Bullish engulfing pattern, right? Everybody see it over here? And I think I highlight it. Okay. Whoops. This ellipse should be over here. Let me go backwards here. So the bullish engulfing pattern, and even something as basic as looking at the angle of the descent, going from lower lows. And what's happening? Bullish engulfing pattern, what's happening to the lows? It's stabilizing. The market's stabilizing. Small clues. Now we're going to look at RSI, another oscillator. Relative strength index. Now be careful. There is a term used in the equity market, relative strength, where we're comparing an equity to its sector or to the overall market. You know, if McDonald's is rallying and the Dow is selling off, people would say McDonald's has a good relative strength compared to the Dow. That's not this. The relative strength index, RSI, is an oscillator, and essentially it compares the number of up sessions to down sessions, the strength of the up sessions and down sessions. Same way we use stochastics, except this has one line, and you could use it for divergence, price extremes, in other words, overbought, oversold. Other things you could do with RSI, you can make trend lines. There are lots of things you could do, but again, I just want to discuss the basics here, show you combining candles with something as simple as RSI. So here, in the stock, market made higher highs. RSI did not confirm the highs. Bearish divergence. Lower lows. RSI making higher lows. Bullish divergence. Plus the hammer, right? And this is interesting. So market has a long lower shadow here, not a hammer. It's becoming a support area over here. And let me draw a pointer. Okay, anything confirming the support now? Okay, bullish engulfing pattern, comes support. Okay. It's a hammer. Could also view it as a crack and snap. We have positive divergence with the oscillator. And let's think about the trade. Where would a potential target be? Once again, you might have a different target, but I would be looking maybe at the highs up here. Right? That's a nice risk reward. Okay. I'd be looking actually for minor, just to make sure, minor resistance here, because see, old support could become resistance over there. So that would be my R1. And what we do for our institutional clients, the more important resistance, we make a check mark. So this would be R2, and I would have a check mark there. Negative divergence, and obviously a bearish engulfing pattern. Okay, now the MACD, how many here use MACD? It's a very, very popular oscillator. And the MACD, you have two lines. The slower line is the MACD. Essentially, the MACD is two exponential moving averages, subtracting two exponential moving averages. For those not familiar, and we'll go over the moving averages later, but an exponential moving average uses all the moving averages. It doesn't cut off any of them. The older ones are weighted a lot less. But essentially, it's two moving averages. And then the signal line is a slower line. It's kind of like the percent K and percent D in stochastics. You have two lines. The slower line is a moving average of the MACD line. But the way we use it is, okay, the MACD line crosses the signal line, kind of like the percent K and percent D in stochastics, overbought, oversold, and divergence. So very similar to all the other oscillators as far as overbought, oversold, and bullish and bearish divergence. So here we have actually two. One is RSI, I believe, and the other one is the MACD. So here we have bearish divergence. And by the way, don't use different oscillators, right? Okay, you use one oscillator, become an expert in it, and stay with that one. Don't have RSI and MACD and stochastics, because they all kind of do the same thing, and they're not always going to give exactly the same signal. And which way do you go? We think the more information we have, the more probabilities we have. You're going to totally confuse yourself. What I would suggest doing is pick one oscillator, and just become a real expert in it. If for those who are not using oscillators yet and want to pick one to really research, I would do the MACD. It's probably the most popular one. From my feedback from both the institutional clients and the retail side is the MACD. Now, keep in mind, it's a lagging indicator, so you're not going to get fast signals. But there's a lot of things you can do with MACD beside divergence and using it to give you overbought, oversold. You can look at trend. You can look at the lines, the MACD line and the signal line to see the direction of the market. So I'd look into MACD if you're not using oscillators yet, if you want kind of a first step. So here we have some bearish divergence, both the RSI and MACD. Okay, a bearish engulfing pattern. And this one was pretty ominous. Once again, ominous doesn't mean the market's going to go to zero, right? It just means the odds are very high of a turn to be a strong resistance area because, first of all, the market's rolling over. And although this is a small black real body, how many real bodies did that wrap around, right? 1, 2, 3, 4. And this is nice because you have a clean-cut resistance area. You have a black candle wrapping around the white real body. Now, beside an oscillator, what do you think I would have on the bottom of the chart here since this is an equity? Volume, right. Again, most of the time the volume is going to be equal between the bearish with the engulfing pattern, the black and white, but I would always have volume on my charts. So here we had a bearish crossover. Okay, and the purple line is the MACD line crossing under the signal. And the actual crossover came here. So on the green here, oops. Okay, this is where the crossover came, the bearish crossover. And not surprisingly, first hint of a turn came with the candlesticks. The question now becomes, so you should have thought about selling here. This bearish engulfing pattern was great. A resistance area, wrapped around lots of black real bodies. And you like MACD, you want the confirmation with the MACD before being aggressively or fully short. You get that on that session, that confirmation, but now you have to look at the risk-reward. Right? But at least you're short from the candle signal. You may not be fully short, but at least you're short. You know. And this is the downside with the lagging indicator. By the time you get the signal with the West, it could be a little late. Okay, so here we have a couple of Hatermy, and there's a dotted red line here. Once again, you could probably see it on your handout a little better, hopefully. Here we have a bullish, kind of not a downtrend, but actually it's still a Hatermy telling us the market is separating from its recent downtrend. But we don't have a crossover yet in the MACD. Another Hatermy, bull Hatermy, still don't have a crossover. And the actual crossover came on this session over here. So now we have a bull Hatermy, and the MACD is above the signal line, so the trend is now up. So you're kind of going in the direction of the trend. And once again, if you're not familiar with this, don't worry. Don't think, wow, there's so much information. The idea is that you're already familiar with how to use the basics of these oscillators. So, okay, here it says on the top, MACD cross, candles for early reversals, and just reflecting what we talked about before, how often you're going to get a reversal signal with the candles well ahead of traditional Western technicals. So here we have a doji, which became resistance a few sessions before, a dark cloud cover, and the confirmation with the MACD came on that red arrow session. Okay, so here we have the MACD cross. So over here, the crossover came over here. So although we had a small bearish engulfing pattern, well, it's small only because I have the scale so compressed, a bearish engulfing pattern here. Okay, the MACD was still above the signal line. It crossed under here. Okay, so now the MACD was under the signal line, and we had another bearish engulfing pattern there. Okay, so this is when we got the negative signal. First negative signal with the candles came here, then confirmation came with the MACD over here, and then a confirmation of the resistance, and the MACD was still under the signal line. The signal line stayed under the MACD stayed under the signal line until here, okay, when we had that bullish engulfing pattern. And here's the case in point. Here's a bullish engulfing pattern, a hammer over here, right? A bullish engulfing pattern, and market was holding support. Not a bad short-term trade for that, based on that. But what was the MACD showing us? The MACD was under the signal line. We did not have bullish confirmation with the MACD. So although we were getting bullish candlestick signals, for those who wanted that east plus west confirmation with the MACD, you did not have it. So if you were thinking of going long just based on the candles, which we normally would not do, but maybe on this bullish engulfing pattern because it was confirming a support area here, you'd probably do it lighter than you normally would do. And again, with option strategies, you could do it with less risk because it's a higher risk trade. So.
Steve, on the right, excuse me.
Okay, a MACD, just some crosses here. Just go through this quickly. And this, I really like this because it has my favorite candle signal, the window. So we have a rising window here. We have a MACD crossover above the signal line. Window's holding as support. We have a bearish engulfing pattern in evening star. And this happens to be the DAX index, just various world markets we included in this session, in the seminar. Evening star, bearish engulfing pattern, and we had a negative crossover in the MACD here. Bullish engulfing pattern a few days before the bullish crossover in the MACD. I'm going through these pretty quickly because there's just a lot of similar examples to show candles and various oscillators. Okay, here we have negative divergence and a MACD cross. So in other words, we had the cross over here, and we had, we know there's not a bullish engulfing pattern, right? Because the trend is wrong. So we have the cross over here, and then when we start to get some negative divergence, the market is making, even the same highs is fine, but we have the negative divergence on that. Now another oscillator, it's not as popular, but I actually use it, is a dual moving average oscillator, where you can subtract one moving average from the other moving average. It's a short-term moving average from the longer-term moving average. So in other words, if you have a 10-day moving average and a 30-day moving average, if the moving average oscillator is 0, it means the 10 and the 30-day are the same price. And I use it as overbought, oversold. So, for example, here, and this is not between 0 and 100. Okay, it's relative to the price action. So here you can see the market's overextended, and so we have the market's overextended, but there's no reversal signals yet. Okay, and the market's overextended there on the right side, and any reversal signals over here, doji. Right. So I just wanted to just have one chart on that, just in case some of you do use a moving average oscillator.